Hi, welcome to the 36 South end of 2025 video. My name is George Adcock. I'm the Head of Trading and Deputy Portfolio Manager for our flagship Cohen strategy. The video starts by looking at some of the observations that we made during previous videos in 2025 and looking at their relevant market impact. We'll then go through what happened during 2025, then further moving on to some of the market pricing and what we believe is elevated sentiment in the market currently. The final part of the video will look at an emerging analog which we believe will create a significant rotation within asset markets. If you could start by just quickly reading the disclosure. Any charts or content that you're interested in within the presentation, please feel free to contact us using the link in both the description and at the end of the presentation. As said earlier, we'll start by looking at some of the points that were made during 2025 and their market impact. Looking at some of the themes from previous updates, we noticed like some core, let's say, trends and observations. When we came into 2025, we saw that the market had very, very high expectations built into asset pricing versus slower cyclical dynamic and relatively tight policy. And we believe that that was a good foundation for a kind of more volatile period ahead of us. We saw that during Liberation Day. We believed that the foundations for a period of market weakness was there, and Liberation Day turned out to be the catalyst to get us there. When we looked at the end of Q1, what we had started to see was that growth expectations were being marked lower. We had started to see that asset price declines had started to affect the US consumer, and that the industrial sector looked quite lackluster. We had also noted that we thought that there was an opportunity in the Swiss franc, and we'll come back to that as one of the things that was kind of a slightly incorrect analysis when we look at some of the action that happened within precious metals. And then at the end of Q2, what we were seeing is that despite a kind of recovery in asset prices, we were still seeing kind of like relative weakness in commodities. And against that, we were seeing kind of like some downside cyclical pressure that was both coming from the labour market and wages and the housing market that was likely to put kind of cyclical downside force on inflation. While that was happening, we could see that there was a kind of two-tier economy that was building under the surface, where we could see that there was significant weakness in the kind of more real world, real economy, and we could see that there was significant strength in the kind of new AI economy. And that was making some of the data quite hard to read. One of the trends that started to emerge during Q2 was that as the dollar was starting to weaken, what we were starting to see was that the Chinese yuan was almost competitively devaluing with it, and that was starting to create an improved liquidity picture. And that was going to create kind of debasement pressure within the system. So if we look at the kind of year in aggregate, actually what we really saw was kind of like quite large round trip in expectations, where we had very high expectations priced into asset prices that became very low expectations. And when we look at the data today, we're back in that kind of slightly more fragile expectations kind of window, where cash balances are very low, expectations are very high, expectations of liquidity are very high, and we'll touch on that later in the video. One of the things that was more challenging during last year was, as I mentioned earlier, this kind of two-tier economy, where we saw kind of like broad parts of the real economy, especially in America, start to slow down, and trying to understand what the translation into asset prices were against this debasement pressure. You know, conventional trades for those kind of markets didn't seem to work so well towards the back end of last year, and really this overwhelming theme and narrative around debasement really drove asset returns. If we just take a quick look at asset class returns during 2025, one of the core themes was a kind of shift away from US dollar assets and the currency outperforming global assets. What I've put in front of you is a kind of quite wide cross-section of different equity markets, and I've put them in dollar terms. And what's the kind of most notable thing is that towards kind of the right side are all of the dollar indexes and assets. Only really India underperforming where the US, what the US performed in 2025. And then some real standout performers in kind of emerging Europe and parts of Asia, where kind of many of these very unloved markets suddenly became loved, and you don't need particularly large capital flows from a very large base in America into smaller markets to generate very significant returns, as we've seen. The other thing that's also worth noting is that, the returns were really split between the currency and the underlying assets. And that has led the market to prompt this end of US exceptionalism kind of theme. As noted on the previous slide, when we're talking about kind of the foreign exchange picture, if we look at the whole year at an aggregate, the dollar was relatively weak against a large basket of currencies. The chart in front of you looks at the total return performance, so it includes the interest rate carry that someone would have received for holding these currencies. And there are a couple of core themes that are really worth noting. One is that Latin America performed really, really well against Asia that continued to perform relatively poorly and has done so for the last few years. One of the more interesting dynamics in 2025 is that as this debasement pressure narrative started to build kind of in the middle of the year, what you could actually see was that the dollar returns actually became much more stable. So the chart in front of you looks at the same chart as the previous slide, but just looks at the second half of 2025. And you can see that actually the dollar was actually relatively stable in that, but there was a huge narrative build. And as liquidity, especially from China, entered the system, it was driving assets and a narrative towards this kind of like debasement pressure. One of the things that you'll notice on the charts is, in general, the high yielders have been the outperformers, and the low yielders in Asia have been the ones that have particularly had a hard time versus the dollar. Moving on to rates, there's a couple of observations that I'd like to make to you. One is that the countries that did the most aggressive hiking cycles, in this kind of sample, that's the UK and the US, have had the best performing bond markets in 2025. And some of that is due to kind of a slight reluctance to ease policy. One of the other core things that's really worth noting is that, China had been a very large force for disinflationary pressure within the world economy, kind of the fallout of its property sector decline. And what we've seen in 2025 is kind of somewhat of a slight regime shift where yields were higher across the whole curve. And this is something that we will touch on later in the video, and whether there's a signal to be taken from that. The other observation that's worth making is that, similar to 2024, we continue to see relentless pressure on the longer end of interest rate curves. Investors really don't believe that there's going to be any kind of austerity, and fiscal expansion and kind of geo-competitiveness will lead to higher terminal rates through time. And then finally, looking at commodities, very, very large dispersion here. At the end of kind of our second quarter video last year, what we had started to see was that despite some movement in kind of precious metals, we were still seeing kind of like a relative underperformance of commodities as an asset class. And, in Q4, that has started to change. We've started to see an environment where the metals rally has started to broaden somewhat. And we will talk about that when we come around to our analog, because we think there's some kind of signal value from that. But when you look at the returns through the year and the returns in front of you, look at the Bloomberg commodity sector world, you can see that it was kind of a mixed bag. Precious metals having a very, very standout performance, Chinese liquidity, debasement trend, a very much a belief that US dollar collateral is no longer the best method for saving within kind of the central banking world. Like I said, like some pickup in base metals following that, then a relatively tight livestock market, which the Trump administration is trying to work on by doing deals with the Latin American kind of economies. And then the other part of the market where we're looking at this slightly more agricultural sector having a pretty tough time. Softs had a pretty good year previously. And then energy, which is like a core tenet of the Trump administration's policy, closing the year like very close to the lows across the board. When you look at the mean on this picture, it is a tiny bit misleading because energy and petroleum are kind of counted twice. But it gives you an idea that if you start taking kind of precious metals out of the sample set, commodity returns were relatively flat within 2025. However, as noted earlier, the dispersion within these returns was very, very large. We didn't have a commodity beta trade. Now we've had a look at kind of like what asset returns have done, it's very much worth asking why. And this chart has been something that we've been relatively focused on through the whole year. And it has led to what I would say some quite heavy distortions in general kind of like economic theory about how countries would work in an interconnected economy. So what are you looking at? In front of you, you have the 1-year inflation swaps, effectively where the market believes inflation will be in 1 year time for the UK, Europe, and the US. Now, at the start of 2025, what we had started to see was that inflation across the board had kind of trended higher, especially since the kind of Trump presidency. Now, once we started to see some of that kind of cyclical weakness and some of that exuberance come out of the market, especially towards kind of Liberation Day, we had started to see this like very large divergence in expectations of inflation open up. We had seen a kind of relative collapse in UK and European inflation expectation against a kind of surge in US inflation expectations. Now, what this does is to push the real rate of interest in America down quite materially, and it makes the kind of the attractiveness of holding US dollars relative to our other currencies, all things being equal with a rates perspective, much less attractive. And that is kind of one of the core drivers of what we believe drove this kind of relatively significant weakness of dollars during the first half of the year. Now, if we go back to this idea of what we were talking about within the last video about this idea that, you know, inflation really comes, especially if service inflation really comes down three channels of wages, housing, and energy prices, we were really expecting kind of the cyclical dynamic to be quite inflation negative in the second half of the year. And the market has moved towards that expectation, which you can see by the green line falling on this chart. And that is likely to be one of the significant factors that drove that much more dispersed returns within the dollar that we saw in one of the previous charts in the second half of the year. As noted on the previous slide, you know, we have these kind of three core pillars of cyclical inflation. We have wages, we have rents, shelter, should we say, and we have oil prices. And what we've seen within 2025 is that, you know, all of these had started to actually resume quite negative trends. And, you know, in the middle of the year, inflation expectations were quite high against, you know, falling trends in all of these kind of series. Now, that has had some relatively interesting effects on the market, not just from this kind of forward inflation outlook, but it's also how people maybe should think about US policy. You know, Stephen Moran, who recently joined the Federal Reserve on a temporary basis, gave a speech at the New York Economics Club just before Christmas. And one of the things that the Trump administration has observed is that when you remove a populace, in this case, kind of illegal migrants into America from a system, what you get is very deep rent disinflation very quickly. And we've started to see in the data that many of the places which had, you know, quite large migrant populations that have now been kind of taken back to their domestic countries are having quite significant rent disinflationary pressure. Now, given how much of the composite inflation indices is made up by shelter, this continues to exert quite a heavy negative pressure on inflation. Another thing that's been quite confounding, I would say, to the kind of conventional economic wisdom was that there was an expectation of like quite significant like wage rises if you took labour stock out of the economy. Now, what we've actually continued to see is that the wages, and on our page on the left, we've got the wage proxy by Indeed, and this basically shows you the year-on-year change in wages for job applicants, and we see similar data in things like job switchers, which has been sliding despite this decline in the labour force. Now, that's either something that you might see in kind of recession type conditions, or it could be something that you start to see in kind of a productivity boom. And this could be the effect of AI starting to have an effect on hiring, where technology spend is kind of increasing relative to labour spend, and we'll only be able to deduce that through time. One of the topics that, you know, I mentioned earlier and that we have raised in previous videos was this idea that there had started to become some competitive devaluation pressure between the US dollar and the Chinese yuan. What does this really mean in practice is that when we've had this scenario where you've had this unilateral rise in US inflation, which has kind of pressured the dollar, the Chinese have taken that as a signal of devaluation pressure, and rather than letting the Chinese yuan appreciate, they've chosen to add liquidity to the system. And you can see this in various liquidity metrics. So if you look at the charts in front of you, what these are is this is the US dollar, the Chinese yuan, and the euro versus all of the G10 currencies equally weighted, which is what I find is a quite good barometer to look at kind of, what currencies are doing in aggregate. Now, when you've got the two largest economic blocs in the world trying to effectively have a devaluation against each other, what that ends up with is all that capital really needs to flow somewhere. And last year, the narrative and the story was very pro-European through this kind of improved fiscal spend to do with remilitarization, this kind of admission under the Draga report that there might be something that needed to change, and a general like re-rating in European assets. Looking forward, we're going to see some interesting dynamics start to unfold here, because a lot of the trade that had been moving from China towards America is now being directed towards Europe, and we're starting to see that trade balance really accelerate between Europe and China, where China is running an increasingly large trade surplus versus the Europeans, and yet the currency isn't adjusting. And that's going to put a lot of deflationary pressure on Europe, and we've started to see kind of murmurs that Europe might have to use the kind of interest rate mechanism to look at lowering the value of the currency, which actually on a G10 basis is pretty strong today. The other thing that we talked about was that this kind of competitive devaluation was driving kind of an acceleration of people's kind of debasement concerns. This became a really, really hot topic in the second half of 2025. And this was a chart that we showed in the kind of second half video for last year, saying that, despite some of the parts of the market looking quite weak, and employment looking weak, and inflation looking quite weak, debasement assets, in this case gold, were a really good kind of like thing to own in a portfolio because the trend had been so strong. And on what you've seen is that this trend has kind of accelerated versus all financial assets. So on the chart you have in front of you on the left is gold versus basically bonds. In the States, you've got gold versus risk parity, which is a mixture of stocks and bonds, and then on the right, you've got gold versus the stock market, and you can see that there's been this transition where gold has significantly outperformed bonds, but until 2025, the stock market had sort of been keeping up with the pressure that was coming from the gold market from this kind of debasement theme, and you can see that really moved significantly during 2025. The takeaway here is that gold has significantly outperformed beta portfolios, and what we've started to see is like an increased weighting starting to come back to portfolios within the kind of precious metal space. If we think about that as a kind of conclusion of like backwards looking data, it's really important to focus about what markets are pricing in today and what participants' expectations are. If we go back to the start of 2025, one of the observations that we had made was that from a kind of sentiment and positioning standpoint, which is one of our investment factors at 36 South, we were seeing kind of like very, very high levels of jubilance. And we're starting to see the same conditions today. And generally, that starts to create the preconditions for a period of market weakness. And we'll go through those charts now. So within 36 South, we predominantly trade options and use options and volatility structures to create asymmetric portfolios, and we are predominantly involved with the tail hedging of portfolios. And by that we mean trying to hedge the kind of the risks that exist within portfolios, and that may be on a left tail perspective, which is what people might traditionally think, which is generally like equity assets falling, the world getting slower, and right tail assets, which is like large scale kind of accelerations in things like inflation, which can have like deleterious effects on a portfolio. In doing so, we track a large number of options markets across the world and try and understand what's good value, where are the kind of Where is the market giving you a free lunch, and where is kind of like the exuberance coming from? Now, in doing that, we have built a large database of foreign exchange options that we collect every week, and we try and look at the percentile of those, going back as far as we have data. And looking at those option prices gives you quite a good window into where the market is kind of discounting like very, very normal times ahead of it. And as I said kind of earlier, you get this kind of, you're more looking towards the preconditions for volatility. So the chart in front of you basically says, of that 750 options, how many of them are in the bottom 15th percentile? And what that really means is that if you're thinking about the combination of an FX forward and the FX volatility piece, that the option prices are really, really cheap relative to their history. Now, what you can see is that recently, prior to the kind of wash news from the US, we've seen that nearly like 45% of our option database was in the bottom 15th percentile. Now, when you go back and look at kind of analogous periods where this has happened, we've generally seen kind of like higher volatility levels ahead. On the far left, we've got the kind of exuberance moving up into the GFC. We got to this kind of 45% level in kind of the back end of 2026. We saw this again during the middle of 2014, which was really just before the dollar had a very significant rally against most currencies. We had a very large oil shock. We saw something in 2019, which was a sort of preceding conditions to the COVID shock in the middle of 2021, where we started to see unprofitable technology start to weaken. And in 2022, we had, a relatively significant shock from energy bonds moving together. And then into the start of 2024, we had this kind of Liberation Day expectation, although I would say that the dollar dynamics have been slightly different within the last couple of years to what we've seen more recently. One of the indicators that we looked at the start of 2025 was effectively within the conference board, they do a survey of how many participants expect higher or lower stock prices. And what we've generally found is that once this gets to a value of 30% net expecting higher stock prices, it pays to be a bit more concerned or a bit more cautious within your positioning. And what you're going to have is a situation where the market either needs to grow into those expectations, or we're going to have to see some weakness to reset expectation and where portfolios are. And we saw that right at the start of last year, and we're back to those levels today. On top of that, we see, and with this data, it really pays to triangulate it. We've seen this corroborated by other parts of the kind of investment analysis landscape. In front of you is a chart that's taken from the Bank of America Global Fund Manager Survey. And what we can see is that we are now at the record low cash ever. And what that really means is that the market is very invested on the kind of status quo conditions kind of playing out. And what we're starting to see is that the odds that the status quo conditions continue to play out looks increasingly low to us. Going back to that kind of theme about triangulating how we should think about these kind of sentiment surveys, there's another survey that we'd like to look at, which is the AII cash allocation of investors. And generally, once we get down to a level of around 15%, once we're below 15%, what you start to see is that the forward returns of asset prices generally start to struggle. And that's what kind of the chart shows you in front of you, with those periods highlighted, over the last kind of 20 years. And what you're seeing is that they've, become increasingly regular previous versus the kind of 10 years prior. So when we triangulate those three things together, both the conference board expectations of higher prices, the very, very low cash levels, and the AII cash balances, we can see that we have kind of the ground set in front of us looks a bit more shaky than where we've come from. We want to generally be thinking about owning asset markets when there's incremental capital that's going to be chasing them to come in. We generally want to be thinking about reducing exposures when everyone is within that trend. Now, one of the reasons for kind of like this very kind of aggressive positioning is driven by one of the things we've mentioned earlier, where we've had this competitive devaluation pressure that has driven kind of a debasement kind of rhetoric, and that has made participants believe that liquidity conditions are absolutely excellent. And what we have started to see in the data that we pay for is that that is actually not so much the case. And there is, some incremental evidence you can see from January where liquidity driven assets like precious metals have started to have a harder time. Now, when you look at this chart from Bank of America showing, how many people are expecting these positive conditions, you generally find that these are the times where it makes sense to step back from risk taking. 2007, just before the GFC, March 2011, before kind of this Eurozone and US debt downgrade. 2013 maybe being a slight outlier, but during that period we started to see kind of the EM sell-off within currencies. Jan 18 was the blow up of kind of XIV, this kind of short vol, kind of heavy short vol market. September 2021, we were thinking really about, Cathy Wood, ARK, unprofitable tech starting to slide, and then, inflation creeping in and increasing kind of energy prices, bonds selling off quite meaningfully, took us from very high liquidity expectations to very low expectations very, very quickly. And then in more recent times, very similar, like we said previously, December 2024, very high expectations of asset price returns, very high liquidity. And, during 2025, in the first quarter, we got quite a big asset class shakeout. Just going back to one of the comments made from the previous slide, we follow the cross-border capital, actually renamed Global Liquidity Indices by Michael Howe. And what we've started to see is in Michael's data, which has been pretty reliable, this liquidity dynamic has really started to deteriorate. And you can see that on the 3-month percentage change on the right, we've actually dipped more down to kind of a negative reading. And, the big takeaway here is kind of the divergence between the data that we see and kind of what is observed within the sentiment surveys. And that kind of dichotomy creates the preconditions for kind of market shocks. The other thing that is just worth noting, and I've just used credit as an example here, is that the market is like increasingly kind of becoming priced for perfection. To incrementally buy asset prices in many markets, this is just US credit spreads, you're really betting on things moving to kind of record levels where you're not being that adequately compensated for taking the risk. So when we add up all of these pieces together, what you end up with is, kind of the embers underneath the kindling from our work that say the forward conditions are likely to be probably more volatile than we've been used to in this recent trend. We've got relatively high asset price, and we've got very high expectations of both liquidity and asset price expectations going forward. And for that reason, you want to be kind of probably in the first quarter, at least of this year, slightly aware of this dynamic when thinking about your portfolio. So having talked about kind of what's previously happened during 2025, and then looking at the preconditions around kind of asset price expectations and sentiment, we thought it'd be worth kind of exploring, what are the analogues of where we could be within the economic cycle today. We've had a relatively interesting dynamic where we've had a very large interest rate cutting cycle while the economy is still generally expanding. And, there might be some analogues from the past about what this looks like going forward. So the following section is really designed to take you through those and look at historically, what has that meant? Because, if this does turn out to be the case, what we're starting to see is that, asset classes that have been relatively unloved might become loved. And, when you have these rotations, you can have kind of quite serious volatility as we realize that capital is generally in the wrong place and it needs to go to somewhere new. As mentioned in the intro, it's worth thinking about kind of, where we have come from in a policy perspective. And I've created this chart which looks at the kind of, let's say, the monetary impulse from 42 central banks. So what it does is it counts the number of either interest rate hikes or interest rate cuts there have been over a rolling 12-month period. And what you can see is that we've come from a position of, like very, very tight policy on a relative basis to a position where we're in increasingly easier policy. And the market has obviously priced this into things like equity returns and credit that was very vaguely talked about in the previous section. Now, what we're starting to see is that we're probably through the top of that impulse, and we're starting to look forward at a situation where we're not going to have so much easing, and we have to look at the effect that this easing should have on the economy going forward. Now, the kind of chart that I think is best to focus on is the one at the bottom here, the bottom panel, which is showing you kind of the rate cut impulse. And what you've seen is that we've really only had, in the last 20 years, two periods which have looked like today. And one was the significant rate cutting cycle we saw in the lead up and during COVID. And the other was post the GFC. And in what kind of central banks in aggregate are looking for is they're looking for a situation where they've added adequate liquidity to the system that the economy starts to stabilize and accelerate. Now, in both of those cases, there was a quite clear playbook about how to think about financial asset liquidity turning into real liquidity within the economy. What's also become very relevant today is that geopolitically, fiscal spending is increasing largely across the whole globe in various different forms. And that's really going to act to kind of turbocharge the effect of some of these easings hitting the real economy. So what I've done is I've gone and had a look at, what would you expect to happen in this kind of environment, and what could that mean if we had an analogous set of market events happen subsequently. And we'll triangulate all the charts and look at what's happening in market prices going forward, or what this has historically meant. The first thing that we would kind of expect to see is that as you transition from, let's say, financial liquidity into kind of real growth liquidity, you should start to see assets that are driven, or their cash flows are derived from real growth, start to improve. Now, the charts in front of you take four kind of commodity proxies and compare them to an equal weight S&P. And what you can see is that, mining was very strong from kind of the precious metals move and kind of a broadening industrial move during 2025. But we've started to see that this rally is broadening versus equal weight beta. Especially we're starting to see some signs of life in energy, shipping is starting to pick up. And these are all the sort of things that you would kind of expect to see if liquidity was entering the real economy. One of the other observations that's worth making is that during this, period of kind of financial asset class liquidity, one of the core kind of areas of weakness in the global economy had been the Chinese economy. And what we started to see within 2025 was this relatively kind of structural downtrend that we've seen in Chinese fixed income yields has started to end. It's a much more stable outlook. And what that is starting to suggest is that liquidity that's been added to the system is starting to find its way into the real economy, and people's desire to hoard government bonds relative to maybe keeping cash on deposit is starting to decline. Now, China being a very, very big consumer of raw materials and being a very large centre for kind of economic growth, this is a signal that's really worth following. So one of the things that we would expect to happen is that when financial sector liquidity is kind of very, very high, or there's an excess of liquidity in the system relative to the growth required by the local economy, is that precious metals should generally outperform kind of everything, which is something that we've seen. And then what should happen is that liquidity should transfer into the real economy, and we should sort of see a changing of the leadership. Now, I use a number of these ratios as interesting barometers to do so. The top chart looks at Glencore, which is a kind of a global trading house, very big exposures in some of the metals markets, versus GDX, which are effectively gold miners. And what you can see is that this has a relatively good oscillating pattern. And on the bottom, I've used a technical momentum indicator called an MACD. And what we've started to see is that the momentum leadership has started to switch from the gold kind of miner outperformance more towards this kind of industrial sector, which is exactly what we would expect to see as that liquidity enters the system. You can see one of the examples that we had on the previous slides that covered the interest rate component was that in the post-COVID era, this was something that we saw in the kind of 2021 here, and you can see exactly the same trend happening today. One of the other areas of the market that you might expect to see some level of economic traction should liquidity start to move into the real economy is the energy market. You know, GDP is effectively energy transformed. And what we have started to see is that, you know, in a lot of the survey data, energy was the maximum underweight, technology especially being like a very high weight, and you've started to see a market where energy is starting to outperform beta. So on the chart in front of you, I've done XLE, which is one of the energy ETFs, which has just broken to all-time highs, versus the S&P 500. And what you're starting to see again on that momentum framework underneath is that the momentum is now pushing in favor of energy equities. Where this becomes relatively interesting is that energy has had a very negative embedded narrative around supply glut, very low positioning. It's a Trump kind of policy prerogative to make sure you have low energy prices. And what we're starting to see is kind of relative strength within the energy sector. And where you get those very embedded narratives and you suddenly get large shifts going on, you can get very large shift in asset pricing. So when we try and look at how we're going to triangulate all these things together, it's then worth looking at what's happening in the underlying commodities. You can have a situation where we have a re-rating within the equity sector, but it's much harder to do that on a physically deliverable good. Now, what we've started to see is that using that same momentum framework, copper, in this case, I've used the LME contract, is starting from a momentum point, starting to flip against gold, so that if you're a long commodity holder, you should be thinking about owning copper over gold going forward if this was to happen. I've put on the chart the kind of previous periods where this has happened, and these have all been relatively significant kind of levels of economic acceleration that we should start to see within the economy, and we should start to see in prices. And I think looking at the following charts, looking at some of these asset prices, you can start to see that capital is starting to find its way into some of these trends. And, in many cases, these trends can last for kind of many, many years. The first of those, and kind of as mentioned earlier, is the oil market. So what I've done is I've taken the same analog from below, which is that momentum between LME copper and gold, and I've just used some green arrows to point at every single time we've had momentum turn up in that pair. And what you're going to see is that this has been a relatively good barometer to expect higher energy prices going forward. On top of that, as mentioned earlier, we've had a very, very kind of like negative narrative around energy and energy prices and energy policy, to the point where positioning is now in our kind of area that we want to think about the market making kind of a structural bottom. And what's interesting is that what we tend to find is on those dates where we had the flip between copper gold, we tend to find that those actually coincide quite well with the market being in very much disbelief within energy. So what you've got in front of you is a chart of Brent spot prices. And then on the lower chart is basically the capital commitment by speculators in both WTI, which is the US contract, and ICE Brent, which is the kind of rest of world contract. And when that tends to fall below $20 billion, we tend to be in the makings of a kind of more structural low. There is obviously one kind of analog here, which hasn't worked, which is 2012. 2012, 13 stands out as quite a meaningful analog across the board. With that being said, the starting conditions of 2012, 13 was very different to today. You hadn't had a very large easing cycle. Liquidity was really just coming from one place, which was in America. So it's worthwhile to note the failure of that analog, but also worth noting the differences to today. And then when you put all of that together, you want to have a look at what's the momentum of the underlying asset doing itself. And what we've had this month is the same crossover in this momentum measure below. And that has also suggested that you're going to have much better supported energy prices going forward. One of the other things that's worth noting just on some of these signals is, they're done over a monthly time frame, so they're actually relatively rare signals. And earlier in the presentation, I said this could lead to a trend that could last a number of years, and historically that very much is the case. So when you think about capital allocation in context of this, you want to be thinking about potentially a very large shift that could unfold over quite a long period of time. This is quite different to some of the things that we discussed in the previous part of the video, which were like very jubilant sentiment that can change very, very quickly. When these momentum of kind of rotation in the real economy tend to change, they don't tend to turn off instantly. Now, when you start to think about what that means, if we start to see higher real growth, we start to see higher energy prices, historically, the market then has to start thinking about pricing in higher interest rates. So the chart in front of you looks at 1 year dollar swaps in 1 year's time. And what I've done is I've taken that same copper gold analog from the previous charts and kind of applied it on here. And what you see is like when this happens, you generally get relatively high, like increased pressure for interest rates to move higher. Now, that's a very different world than what we discussed earlier, where we have, very, very loose FCI conditions across the board. When you start adding in the potential for maybe higher rates, you start adding higher energy. That's not going to be so good for certain cohorts of the market that are either short those products or rely upon kind of declining discount rates for their valuations. Now, there is obviously some interesting dialogue to be had around kind of the independence of the Fed during this kind of dynamic, because if the interest rate mechanism is somewhat broken because there is kind of political pressure for lower rates, while this happens, you could get, I think quite accelerated moves across the commodity complex, and you might find that certain currencies, especially the kind of the dollar in that case, could be very weak. Now, it's not clear today that that is the case, and I think for now, given that Walsh has come in as this kind of slightly more establishment figure, if this dynamic continues and we get kind of a regular market pricing cycle where energy is more supported and liquidity is entering the system, you're going to see a situation where there's topside pressure on short end interest rates, and that should keep low interest rate currencies under quite a bit of pressure, especially those that need to import energy. Where else might you find investment opportunities? And many of these aren't particularly relevant to 36 South, but they're very much worth kind of exploring. One of the sectors is chemicals. Chemicals have a very, very good link to economic growth, and we're starting to see considerable strength within some of these chemical sectors, breakouts from very big downtrends in many of them, high volume, and this might be a sector for those who own beta assets that rotation could definitely happen into, and a sector that's probably relatively unloved. Building on kind of the energy story for those people who don't trade in the underlying products, the equities obviously are another option, and what we've started to see is that the energy equities are now starting to really perform. We've started to see XLE, which is the ETF kind of index of many of the largest of the firms has broken to new all-time highs. I've taken Chevron here, which is a pretty large global energy producer, and you can see that the arrows have had like very, very high hit rates through time, and Chevron is breaking towards all-time highs now and has quite a constructive chart pattern. And like I said earlier, as this money ends up in the system, it's commodity type assets that you tend to want to own. And when we start to see improved momentum in industrial assets relative to kind of more financial assets or liquidity based assets like gold, what we should expect to see is the commodity rally broaden out. And by that, I mean that some of the sectors that we had seen earlier in the presentation that were doing not so well, specifically energy keeps coming up as a topic, should start to see some strength if historic kind of correlations hold. In the kind of more like beta marketplace and thinking out on a country level, what we tend to see is that when you get this dynamic, money then starts to flow to the economies which are either more growth sensitive or the economies that have kind of big commodity production kind of constituents within them. And historically that has meant that the emerging markets, countries like Brazil and South Africa, start to trade really, really well. And we've started to see a situation where many of these indexes are starting to break to all-time highs. Now, we're obviously in a slightly strange environment where we've got like a very all-invested market and then some of these dynamics happening at the same time. So there is definitely some caution to be taken around some of these trends and the exuberance within them. But, the long-term trends, given the kind of monthly nature of this kind of switch, these are places where, capital is likely to get put to work on any real weakness. And then within the US kind of cap structure, it's really the small caps that are going to do better in this environment on a relative basis. And that might be value, the kind of value factor that some people call it, relative to kind of the growth factor, where the economy is now actually growing and these businesses go through a transition where their balance sheets, etc., start to look much, much better than it did before. And we've started to see this as the Russell 2000 has kind of broken out to all-time highs. For those looking at currency markets or FIC markets, kind of in more general, one of the kind of emerging themes that could play out here, and we're starting to see it in market pricing, is that if real growth is to accelerate, what we're going to see is we're going to see kind of an economic flow from those who have the raw assets receiving capital and those that need them starting to weaken their currencies kind of as this happens. Now, I've given the next two slides the Australian dollar, which is kind of a resource heavy economy in metals and gas, and then I've done the Brazilian real afterwards. And what you're starting to see is that if you compare the Aussie dollar versus the 5 biggest importers of energy, which are Europe, China, Japan, Korea, and India, you're starting to see significant currency strength and what looks to me like a kind of more like structural rounded bottom. And you can see from the early 2000s that these trends can actually last for like quite a long time. So we're seeing this like quite large capital rotation within this sector. As I said on the last slide, this is Brazil. Now this slide takes into account the interest rate carry. It's worth thinking about that when generally looking at emerging kind of like currencies. The total return effect is quite a lot bigger. And you can see that, this the Brazil versus these energy importers had really been, and this one has taken China out of the data set for kind of lack of data, but tenor has been in a relatively stable kind of channel from basically 2009 to 2024, and now we're kind of off to the races again in Brazil on a total return basis. Now, one topic that's worth touching just within this is, what's the role of the dollar here? Now, traditionally, we have seen a market where the dollar has gone down and commodities have gone up. That dynamic is quite complicated today. We have a situation where the federal policy might be kind of interfered with, which is going to create kind of a quite slightly strange dollar dynamic. But on the other side, the US has become quite a large resource exporter through its energy channel. So, a stronger energy market is actually kind of like a balance sheet stronger in America trade. And, when we look at the FX landscape, the last kind of 15 years, 20 years have been really centered around these kind of like high beta dollar trades. Dollar goes up, dollar goes down. And what we continue to see is more opportunities in some of the crosses where you see the haves and have-nots from these potential economic moves moving quite materially against each other. So basis what we've seen in all of the charts kind of that have been presented to you, if we were to kind of look at the overall kind of rhetoric that's worth thinking about, we've seen a situation where we've had a very large round trip in expectations. We've had a situation where investors are largely invested in very, very similar assets. And now we have a situation where sentiment is very, very high. Now, that starts to create the preconditions for a period of market weakness within those assets that the market has exposed themselves to. And 36 South, through its positioning, tries to expose itself to hedging some of those assets for our underlying customers. Looking forward, however, we're starting to see this trend where real economic growth might be starting to occur, and this is what asset prices are starting to price from this incremental stimulus from monetary policy, fiscal policy, and liquidity hitting the system and starting to percolate through the real economy. And that then changes how asset allocation should be thought of forward. And in the slides that we've just covered, I've tried to give you some kind of analogues of assets that in those environments tend to do quite well. I have a couple of closing thoughts for you on this, and I'm going to take you back to the presentation. So to illustrate kind of where we might be with some of this rotation, I thought it would be interesting to show you just how different the momentum is between some of these sectors. So we continue to use this monthly MACD momentum signal. And what you can see is that the blue line is now rolling over the yellow line. Now on the left-hand side, we've got the New York FANG Plus Index, which is effectively large establishment technology companies. And on the right-hand side, we've got the energy companies. And what we're starting to see is that for the last kind of 5 to 6 years, these things have been moving really in kind of opposite trend to each other. And this really is kind of a financial asset growth, kind of technology story, and we discussed this kind of K-shape economy earlier where, the financial assets did really well and the bottom guy did really, really badly, and that's kind of quite well reflected through the difference in these two momentum buckets. And now what we're starting to see is that start to change. The leadership looks like it's moving to more the real assets, which is, in this case, energy companies relative to the growth in the kind of technology companies. As touched on earlier, this could be a very, very different landscape to think about. When we've historically had shifts in energy companies like this, we've started to see upward pressure on interest rates. And what I've done here is I've put XLE, that same XLE chart, and I've put it next to the kind of 10-year interest rate in America. And what you can see is that once the momentum in the XLE starts to turn up, you generally get a coincident turn up in the kind of 10-year yield momentum. So when the market has built all of its positioning on kind of relatively easy FCI position, is very exposed to kind of growth assets, AI technology, and is very, very underweight some of these energy, real world chemicals kind of sectors, what you're very likely to see is to have a very large scale rotation. Now, in the first couple of days in February, we've started to see this where software has been very weak and energy has been very strong. And, when you get these large hoardings of capital what you tend to see is that like there's no real easy way out and there's no real easy way in. You know, one market can be a lot larger than the other, and who's going to be the incremental buyer or seller who's going to make that transaction for you. And we believe that this could be a kind of source of quite large instability as this kind of rotation could occur. And given where the sentiment is, you know, there is significant potential for kind of like quite a volatile period ahead of us in areas that are well exposed to kind of like the old system, or not the old system, but like the previous assets that have been doing really, really well from this kind of 2023 to now period. We hope that you've enjoyed the presentation today. If you'd like to see more content like this, please subscribe to the YouTube channel or follow us on LinkedIn, where we post regular updates. We'd also welcome any comments about things that viewers would like to see in future, or topics that you'd like us to cover. And we look forward to seeing you soon.